welcome back. I'm Pierre Daillie, Managing Director at AdvisorAnalyst.com, and this is Insight is Capital. For decades, covered call strategies have followed a familiar rhythm. Write an option once a month, collect the premium, and wait for the next cycle. But the options market has changed dramatically. Today, same-day options known as zero-day-to-expiry options now account for a massive share of daily options volume. And they've introduced a completely different way to harvest volatility and generate income. Instead of writing calls once a month, strategies like Hamilton ETFs, DayMAX ETFs write options that expire the same day, potentially monetizing intraday volatility hundreds of times a year. The idea is simple but powerful. Combine daily option premiums, modest leverage, and partial call coverage to create a strategy that aims to generate frequent cash flow while still preserving meaningful equity upside. To help us understand how this works in practice and to understand, first of all, what zero-day-to-expiry options are and what it means for investors and advisors thinking about portfolio construction, I'm joined by Nicolas Piquard, Chief Options Strategist at Hamilton ETFs.
This is Insight is Capital. Join us in our fireside chats with some of the most fascinating people in finance to discuss their insights on life, markets, macro, investment strategy, and much more.
Nick, it is terrific to have you here. Thank you so much for joining us, and it's great to see you.
Thanks, Pierre, and great to be here, and very excited to talk about these zero-day-to-expiry options and how we use them in DayMAX. So.
Pleasure. It's so great to see you. Thank you so much for coming on. I think there's a lot of mixed notions or mixed, misconceptions about zero-day-to-expiry options. And but before we get into the vehicle, the options themselves and the strategy themselves, tell us about the arc of your career and how you came to lead the options team at Hamilton ETFs. What's the background that has informed the way you approach the space?
Sure. Yeah. I've been trading equity derivatives for close to 30 years. And I have a bit of an interesting background in terms of, my career arc. I spent the first half of my career as a sell-side options trader. So working for the banks, pricing the options, giving clients the best price that we could on various option trades and whatnot. And I did that for close to 15 years before I moved over to the buy side as now the one asking for the prices and the one trading on the other side. So it really gives me a bit of a very interesting perspective relative to a lot of other people in the industry, because I've been on both sides of the coin. I've been the buyer of the option as a sell side trader, and now I'm the seller of the option to try to collect those premiums. And it gives me a bit of an advantage, I guess, because I understand what the traders are looking for, how they view monetizing volatility and being long volatility, whereas we're on the other side. We're trying to sell volatility and monetize our premiums that way. So it's been a very rewarding career, and I'm very glad that I've had the opportunity to do both.
I bet. And you run a team now at Hamilton ETFs, and how does that complement your experience?
Yeah, well, we've had fantastic growth here at Hamilton since we joined. We now have close to $7 billion in our yield maximizer ETFs, and we have almost $750 million in our DayMAX ETFs. So it's been fantastic growth over the last 3 years, and now we're building out a team. We've hired another senior portfolio manager to help me manage, because now we have so many more ETFs. We have close to 13 now to manage. So that's been a great process as well. And we have some great talented individuals in our trading team as well. So now we have close to in total six people. We have a few traders. We have 3 PMs in total. So it feels like every time every month we're like, oh well, we're getting busier and busier. But I think that what part of the reason we've grown so quickly, and that we've had a lot of success with both our yield maximizers and our HDIV and HShield, which kind of use a little bit of leverage, and our yield maximizer ETFs as well, and now the DayMAX, is because it fills a need for the market. It fills a need for clients who are looking for more income, who need a little bit more income than what regular fixed income or regular dividend stocks might give them. And so for advisors and their clients, it really fits well into their portfolios.
Yeah, and clearly the street seems to think so as well, right? So I think you've had some great traction. I want to now get to this question of 0 day to expiry options, the 0 DTE options that have exploded in popularity in the market over the last few years. Because I think that's where I think there's a lot of mixed notions or misconceptions about what they are, because it's actually a structural shift in how volatility and option premium get distributed across markets. Is this actually a structural shift in how volatility and option premium get distributed across markets, or are we watching a trading fad that eventually fades? That's where I think a lot of the misconceptions are, is what use are 0 day to expiry options?
I think that, first of all, I think what we need to do is we need to go back and look at how did 0 day to expiry options come about?
Right.
And, how did we get from having just regular expiry options to like a regular monthly third Friday of the month? As we know, it's always the third Friday. You get options expiry, and you call it triple witching and quadruple witching. Everyone talks about the volatility on those days, but how did we get from that to 0 day to expiry options? And it was very gradual. It wasn't like overnight. Let's talk about listing options every day. What happened is, about 20 years ago, they started listing more expiry, so doing weekly options and quarterly options. So options ending at the end of every quarter, options ending every week. They started adding more options listings on top of the regular monthly expiries, and that got some more success. People liked the fact that they could fine tune a little bit more of their risk. They could decide, okay, well, I don't want to buy an option expiring on that third Friday. I'd like an option expiring at the end of the quarter, right? Like an option expiring at the end of this week. And I think what you notice is that more and more people were trading those weekly options. So then they started listing options that would expire on the Monday and the Wednesday and the Friday as well. And also those got more traction and more liquidity and more volume. And so it kind of led the market to realize there's a real demand for hedging risk and trading these options at various intervals, because people had different views depending on news that they might be expecting or how it fits their portfolio and their cash flows. They really like the granularity of having options that expire at a certain time. And so in 2022, they listed every day of the expires every day out to a month, basically. So, if you look at options, the option screens today on the S&P, you'll see one expiry for every trading day for the next month. And that really allows the traders or the investors to hedge their risk pretty with a lot of granularity over the next month. But what we found out, or what you're finding out now, is most of the volume happens on the day of the expiry, on the 0 day to expiry. And that's because there's a lot of people who are willing to take a view on the market for that day. Day traders, there's going to be a lot of people who are looking to hedge short-term risk or trying to take a view in the very short term. And so now when we look at the options volume, this is probably one of the most successful, option listings, I guess, for the exchanges that they've had in a while. And I wouldn't be surprised. Now we currently have these 0 day to expiry options on the S&P 500 and on the NASDAQ 100. And they're starting to trade a little bit more on the Russell 2000 as well. But I wouldn't be surprised if we start to see these 0 day to expiry options listing on more asset classes as we go.
That's remarkable. I mean, when you consider the size of the indexing in S&P 500 and NASDAQ, it's certainly, there's so many different ways, obviously, that these zero day options can be used. Ways of using 0 day options that are either for risk management, insurance, in the case of your strategy to write covered calls on the 0 day options for income, for monetizing volatility, daily volatility. So that's extraordinary, and I think thank you for elaborating on exactly why these options came to market. I think it helps to get into the topic of how you're using them and what made it possible for a strategy like DayMAX to exist at all. And like when we look at traditional covered call ETFs that write monthly options, managing daily expiring options sounds like an entirely different discipline. I know, you're still doing the traditional covered call strategies, but how did moving to a 0 day framework change the way you think about volatility, premium generation, and risk management on a day-to-day basis?
Yeah, well, we spent quite a bit of time deciding how to structure our DayMAX ETFs, because monetizing daily volatility is quite a bit different from the traditional, selling your monthly options that, most people would be familiar with and that I'd been doing for over 10 years. And, trying to figure out, okay, what is the right strategy to use when your option is expiring every day rather than expiring every month. And so we spent quite a bit of time trying to figure out, what's the best way to do that. And we didn't want to rush into anything either, because as we just alluded to, these options are relatively young. They've only been around for 3-4 years. So how is the market going to change over time? How do these 0 day to expiry options trade? And we did quite a bit of analysis and quite a bit of thinking about how to adapt the typical covered call strategy to a more short-term daily expiry. And one of the things that you do hear quite a bit from people who are just looking at 0 day to expiry for the first time, it's it's very speculative, it's very risky. There's a chance that you're going to lose all your premium in a day. But at the end of the day, it's just the same, it's really the exact same thing as a monthly option. The only difference is the time to expiry. And for the same reason that a monthly option can expire worthless. A daily option can expire worthless. It's just the only difference is the speed at which it does. I think where people think it's risky is because, you can use quite a bit of leverage if you're buying a 0 day to expiry options to get exposure to the market. But the way we do it, we use the same covered call strategy that we use for our other covered calls, where the call is completely covered by the underlying. So there's no additional risk from that perspective relative to any other, covered call strategy. So the key part was, what's the big difference between a monthly expiry option and a daily expiry option? Well, the big difference is how often it resets and how often you have to have a new strike and more premium every day. And so the big advantage is that you're getting more premium because as you learn from your option textbooks, if you going back a far amount for me, but if you recall from your option textbooks, most of the time decay happens at the end of the option's life, if it's at the money. And so for a daily option, you're basically maximizing that time decay. Now, most people, when we started doing covered calls, and forever, covered call strategies have been around for a very, very long time, and they've always focused on those shorter term options, those 1 month options, because that's what was available. But now we can go even shorter term. We can go, 1 week, 2 weeks, and now down to 1 day. And so that 1 day gives you the most premium, but it's not an entirely free lunch, because what happens is, because you're resetting your strike every day, you're also giving up that upside on a daily basis. You're no longer giving that upside on a longer term. So if the market's down 1 day and then recovers the next day, you're going to give up that upside on the up day. And so it's very important to have a strategy that's, sustainable over time. And, that's why we spend a lot of time working on a strategy that we think works over time, not something that, you're just going to sell your upside every day on 100% of your holdings. And then, slowly that, you're not going to get any, upside for the portfolio if you do it that way.
Yeah. So Nick, before we get into the design choices, I sort of want to preface, for advisors and investors listening, so they have a clear mental model. It's not so much that you're using them, it's how prudently and thoughtfully you're using them that matters, right? Like, I think people automatically think, oh, what's a 0 day? That must be, like you said, it must be speculative or it's risky. But no, it's covered. In your case, in the case of the DayMAX strategies, it's fully covered. You're not trading naked. You're not doing anything extraordinary in terms of sizing. And so it is how thoughtfully it is how thoughtful, like to your point as well, you're using 0 day options that actually matters. Not that you're using them, but how you're using them. So walk us through what the DayMAX ETFs actually are, first of all, so that folks understand, how they work, how they're structured, what they hold, and how they're meant to fit into a portfolio. Because I think once you sort of get the lay of the land, where the exposures are, like where the writing is, what the components of the portfolios are within the DayMAX suite. I think given the fact that there are surely some preconceived notions about 0 day options, I suspect that without taking a closer look, many advisors and investors alike might not fully appreciate what's under the hood.
Yeah. And
right? I think once we have that foundation, sorry, Nick, once we have that foundation, then let's get into understanding the role that the partial call coverage and modest leverage play in balancing income generation with the equity participation, which is really the underlying, motive, getting both, but without sacrificing anything to do it.
Yeah. No, and of course, as with any new product, there's always an element of education and explaining to advisors and their clients, what are we doing? Why might this product work for you? And when we decided to structure this product, we were very mindful of the fact that because you're selling those daily options and because you're selling those ODTE options, you are giving up quite a bit of upside, and you're doing that on a daily basis. So how do you structure an ETF so that you're still getting you're capturing those premiums, but you're still allowing the ETF to some exposure to the upside. And so what we decided to do with the DayMAX is we decided, okay, we're going to own 100% of the fund in our Champions ETFs, which are ETFs that we've launched, which are low cost, but that focus on what we call champion stocks. So for SDAY, for example, which is our US DayMAX ETF, we own SMBP, which is our US Champions ETF. And the US SMBP owns dividend growers, stocks that have grown their dividends over a long period of time. And so that they're kind of safer generally than, your average, stock, maybe a little bit less growth, but a higher yield. And because we're focusing on an income generating ETF, it made sense to own those dividend growers and those dividend stocks. It also has the advantage of having a lower volatility than the index. And so because of that, we can add some leverage. So each of the SDAY is going to have 100% of SMBP and 25% of S&P 500 exposure, and we get the S&P 500 exposure through owning VOO, which is a very, very low cost S&P 500 ETF. So kind of have an 80-20 split, but then after the leverage, it's going to be 100 of the SMBP and 25% of the VOO. And that modest leverage, has, we have used the modest leverage in some of our other ETFs. Clients are very happy with, a little bit of extra risk, but you get more of those returns to the upside. And with the SDAY, what that allows us to do is to write only on the 25% VOO that we own. And so you're really not covered on 100% SMEP. So the idea is, yes, on that 25% VOO, you're going to give up that daily upside, but you're not giving up the daily upside on the SMEP Champions ETF.
Yeah, see, that's what's so nifty about it, right? That's kind of what's nifty about the suite, whether it's C Day or S Day. The underlying fund that you own, you're not giving up any tracking on that, right? Like on the SMVP, you own $100 of SMVP, and it's going to do what it's going to do, right? It's going to, you're going to get all the upside naturally, because it's a long only fund. You're going to get also some of the downside when it happens. You're going to get the downside like you normally would, but you're not eating the upside because you're not writing against SMBP, right? That's what's nifty, is that you've used some capital efficiency to get that 25% and use it to purchase VOO, and you're writing against that and only that. So you can write against VOO every day, which is what you're doing on a 0-day option, right? You can write against VOO every day of the year without ever having an impact on the underlying SMBP holding.
Yeah, and that's exactly that's exactly what
right?
we were looking for when we structured the product. Now, that being
That's
said,
a really interesting overlay. I mean, yeah.
I think that being said, because you're writing on a daily basis on that VOO, there are times where the premium, the market's going to go up and we're not going to capture our premium, and we'll in times where the market's going to go down. But because markets go up in general, that VOO portion is, you're not going to get much upside or any upside on that because you're fully written. And so,
right.
That's the part where you have to be cognizant, is that this is the part of the portfolio that we're generating premium on. We're not getting upside on that at all. So
very interesting. Now here's something that might surprise people, and that's because the options expire each day. That portion, that 25%, that's on top of the SMVP in the example we're talking about, that 25% maintains full overnight exposure. So because the 0-day options expire at the end of the trading day, overnight you still participate in the upside. Right now, you had a nifty chart. Like, why is that feature so important from a long-term portfolio perspective, and how does it differentiate this from strategies that stay hedged 24/7 around the clock?
Well, actually, that was one of my big surprises when you're working on this product and working on different strategies that might work in better or from the total return perspective, because of course you could sell your 0 DTE options, the night before, right? But right at 4 p.m., your old one expires and you just write a new one. So why wait till the following morning, which is what we do, to write your option? There's a slight cost to that because we're getting slightly lower premiums by waiting until 9:30 the next day to sell our option. But that was one of the big surprises for me when working on this idea, and not something I paid close attention to, because this effect is actually quite hard to take advantage of. It's the overnight returns in the stock market. And there's a chart that we show advisors, where we show a dollar invested overnight versus a dollar invested during the day session. So a dollar invested between 9:30 and 4, and what the difference in returns between overnight returns and the intraday returns. And it's pretty surprising when you look at the numbers. About 80% total return is been in the overnight session. And so if you'd invested $1 in the S&P in around 2000, and today it would be worth, $100. Today it would be worth $694. Okay. And if you spent that same $100 and invested only in the overnight, that would be worth $548. So a big portion of that return. Whereas if you invested $100 and only held your S&P exposure during the day, so from 9:30 to 4 o'clock, it would only amount to $120 $27. So it's pretty incredible to me. And that effect been pretty consistent over decades. I went back and looked at some research by the Fed, by other academics who've looked at this phenomenon, and it's been around for quite a long time. The only thing is it's very difficult to take advantage of because, you have to basically trade on the close, then trade again in the morning, every day. And for a lot of traders, that's just not practical. And in fact, for a lot of day traders, it's not so, they don't want to carry that overnight risk, which is why they sell it for and then maybe get back into the market the next day. But during those overnight sessions is where all the economic news comes out, all the earnings news comes out, all the market moving information is generally disseminated in that after 4 o'clock, after the market closes. So if your stock has good earnings, if you have good news, being disseminated, that the next morning the markets will open higher. And so by not
that's when you get that gapping happening on many trading days.
Exactly. And I mean, by not being written during that period, we think this gives the DayMAX a big advantage, because when do you want to be writing calls? You want to be writing calls when there's limited upside. And so it seems like the day session is perfect for that, because it doesn't have as much upside historically. And so, we don't, markets might change, and we don't know if that, how much that'll keep going, but that's been the trend for decades. And so that was the aha moment for us in launching and designing these products. Is okay, in the overnight session, we have 125% exposure, and we can capture that upside, but we're going to limit our upside only during the intraday session. And and before zero DTE options, you couldn't really do that, right? You can't do that with a regular monthly option or regular weekly option. You can't take advantage of that phenomenon. It's only since these options have been around that you can take advantage of that from a covered call perspective. So that's when all the ducks got lined. All the ducks got lined up for this product. Is okay. Let's have a long equity product with a little bit of leverage, but not written overnight. And so that gives us kind of the best of several worlds. It gives us the additional premiums that we're getting from writing daily, but it doesn't limit too much of the upside.
It's actually, I mean, it's a remarkable spread. So much activity happens at the opening bell because of overnight trading, and the markets gap up or they gap down. But if you're already there in this case, because you're in the index on an overnight basis, uncovered, then you do get the benefit of those gap up openings when they happen. And that's what's in this chart, right? Is you're getting the reaction. And then once the market has opened, then you're stepping in to sell the options for that day after the market has opened. So you're capturing whatever happens that day, and you can make decisions based on how the market opens that day about how you're going to, sell, how you're going to sell options that day for that market based on how the market opens, but not subject to the market open.
Absolutely. And, on a day where things open quite a bit higher, there's very, very good news. I mean, we're happy to wait 5 minutes and get a slightly, better price. So a lot of times on good news events, the markets do show quite a bit of momentum. And so, if we wait, 5 minutes or 10 minutes, we can get, a better strike and give up, even less upside. So it does require quite a bit of more work. And I think that, that's also one of the reasons, we wanted to make sure that we had, the right team in place and, enough people to staff a product like that, because, we're trading every day. One of the reasons a lot of advisors have shown interest in this product is because even though they may be doing cover calls themselves for their own clients and in their own portfolios, doing the DayMAX, replicating that is a totally different story than selling an option every other month or every month. And doing it every day, that means you have to be at your desk, at 9:30 every morning and making sure you get that daily premium. So it's quite a bit more work for us, but it's very rewarding. Especially, when you see those gap ups, you're like, yep, here it is again. We're able to take advantage of that. So, and then, on the other hand, of course, there's going to be the negative stories that come out overnight. We've had a few of those recently. And of course, you're going to have, at that point, you're going to have some negative overnight returns. But actually on those days, what's interesting is because the volatility is quite a bit higher because of the uncertainty, we're actually able to reduce our coverage. This is one thing that we do for all our cover call ETFs, is that we adjust how much we write based on, it's not a static coverage. And so in a higher volatility environment, we don't need to write on 100% of that 25%. We can scale that down based on, the income that we need for the portfolio. And so in the last couple of weeks, where we've seen quite a bit more volatility in the markets, we've been able to reduce our coverage so that, if things open down, but then rally during the day, we will give up some of that upside, but not as much as if we've been, 100% written.
Yeah, you're right. Lately, we've had a lot of over the weekend activity, never mind overnight. Things start on a Saturday and then the session opens on, the international sessions open up Sunday night, and you see, what's coming in the morning, right? And so that must be very interesting. So you're actually, you're doing all that risk management, and you're right. I think, I can't see why an advisor or an investor would want to try to do that themselves.
It's a lot of work. In fact, not only would it be a lot of quite difficult, but it's actually quite tricky from a trading perspective, because we're selling the index options. Advisors might have access to those markets, but a lot of individual investors won't even be able to trade one because the notionals are so large on those indices. But that's actually one of the things that make it work for us, because one of the things that you have to remember is that we're trading every day, so we got to pay commission every day, and so we have to make sure that the amount of commission that we're paying relative to the premium that we're getting, it has to make sense. And so for the index option, they have very, very big notionals because they're based on the index. So on the NASDAQ is 26,000, and on the S&P, it's again, it's like 6,000-7,000, right? So these notionals, we don't need to write too many index options to achieve, even on a bigger portfolio to get our premiums. But if you're an individual investor, you have to invest quite a bit of money before you can
Yeah, you have to have the scale, right? I mean,
exactly.
you're coming in with size, but an individual investor, like even an ultra high net worth investor, would have to scale in properly in order to actually do it right. And as you said, the trading costs for doing that, the sizing, that's a lot of groundwork every day for an individual to undertake. Nick, if you had to explain, I know we just went through this very, we had quite an elaborate conversation so far. But if you had to explain what DayMAX is actually doing every day in a simple analogy that a client could immediately grasp, what would that be?
The way you would explain it is you would start from a regular covered call strategy. If your client understands a regular covered call strategy, I think that's the best way to start. So look, this is just like any other, covered call fund. You own, the underlying and you write an option on that underlying. It's no different. The only difference is that it's expiring every day. That's the big difference. And so then you have to say, well, how does the option expiring every day impact my investment? And in two ways, effectively. The first way is that collect more premium because you're writing 20 options on average day, 20 options every month relative to one option, you get a lot more of an ability to raise premium. But more premium means you give up more upside, right? So there's always you get more premium, but you also give up more upside. That's always kind of the trade-off between getting more premium. Generally means you have to give up more upside, and so that's how you have to explain that. It's like, okay, well, we're getting a little bit more premium because we're monetizing daily, but that means we give up a little bit more upside. So then the client is, well, okay, well, how are we maintaining upside? Well, and that's where you can get into the overnight returns. We're not covered in the overnight market, which historically has been where most of market returns have been. And you're also writing on only the 25% of the modest leverage that we're using in the product. So those are the two things that kind of make it quite a little bit different from your regular covered call. But at the end of the day, when you're looking at in terms of risk and return, it's yes, there's that a little bit of modest leverage, so you have to keep that in mind. But outside of that, it's not that much different from kind of any covered call product. But it does one of the big things is that it's a different way to monetize volatility in the market. For the better part of a few decades, traditionally covered call funds have been focusing on monetizing that monthly premium or monetizing that quarterly premium, whatever that may be. And monetizing that daily premium is just another way to monetize volatility in a way that until recently we didn't really have the opportunity to do that. I guess those are the several ways that you can approach a conversation with a client. Like covered calls, you're monetizing volatility, but instead of doing it on a monthly basis, you're doing it on a daily basis. And there's different risks and returns associated with that. But generally, this is why we have this, slightly higher yield on those DayMAX ETFs relative to regular covered call ETFs, because we're able to monetize those daily premiums. The nice side benefit as well, the additional benefit for that is because we're getting that premium every day, we're able to pay more frequent distributions, which means that we're now paying those distributions twice a month, instead of once a month. And so,
And that's helpful for so many reasons. I mean, especially if you're considering, retirees, right? I mean, people who are investors who are investing specifically for the income. It's nice to get 2 paychecks a month, right?
Exactly.
From your investments.
Till the end of the month for your premiums, you can get it.
Yeah.
So, yeah.
I just want to revisit before we just continue or bring our conversation to a conclusion. I think the key is that, you've got that, what I think is really interesting about how you've structured these ETFs. I think it's the opposite. People have long made the argument that traditional covered call ETFs, cost you some of the upside of the portfolio. And that really is largely dependent on how much you write, right? If you're just looking at if you're just looking at a buy right strategy trading on US exchanges, some of those buy right strategies are writing 100% against the portfolio, right? That's obviously going to eat all the upside.
Correct. And that's
from the underlying.
Yeah.
But then you look at traditional covered calls where you're writing 20, 30, 35%, 50% of the underlying. You're going to have some of the upside eaten away by the trade-off for the income, but you're getting the income. So that is the trade-off. And that is a concept that took a fair bit of time for people to grasp and accept. Is that, okay, I'm getting into this particular vehicle, this fund, because while it costs me a little bit of the upside, some of the upside of the underlying equity holdings, I'm getting this much income on this. I'm getting this yield that makes up for it on the other side. What I think is interesting about, if I just as an observer here, what I think is really interesting about your DayMAX structure is that you've got $100 out of 125 is in the S-Day example in SMVP, which is your Champions US ETF. No writing against that. So whatever upside there is, it's all yours. And then what you've done is you've used this capital efficiency to add this 25% in VOO, and by capital efficiency, I mean you've used a light amount of leverage to add that 25% portion on top of the 100%, and you're writing only against that. So the only portion of the portfolio that might get, whose upside might get eaten by writing options for income is that 25%. So you've kind of figured out how to do it. And that's thanks to the 0-day options. You've kind of figured out how to provide a covered call ETF that doesn't give away the upside on the $100 of the underlying fund.
Yeah. And
that's pretty nifty. That's
nifty. And I think the other realization that we got from thinking about it this way is that we were able to say, well, we wanted to offer, not just S-Day, but we wanted to offer a product that was available for people who wanted exposure to Canadian stocks as well. Of course, we don't have 0DT options here in Canada. For C-Day, we invest 100% in CMVP, which is the same kind of an idea as SMVP. So it's our Canadian dividend champions. And in that fund, we invest in all the dividend growers in Canada. And so that allows us to have that Canadian exposure but then tack on that 25% VOO on which we do the S&P 500 zero DTE options overlay. And so we're able to give a product that is mostly Canadian, with mostly Canadian exposure, but takes advantage of
Right.
those zero DTE options.
Yeah, the only reason I stuck to the S-Day example because I didn't want to put too many ingredients in the conversation into that punch bowl, right? Like, I think just to keep it clear, but that is also very interesting to look at C-Day and say, okay, I've got 100% in CMVP and I've got 25% in VOO, and all the income that's being generated from monetizing the fund is coming from the VOO portion, not from the Canadian portion.
And the nice thing about using the CMVP and SMVP, of course, they have slightly lower volatility than the underlying indices. And so, even with the modest leverage, it's not because those, the indices that, because the indices that track, that we track for the champions have historically had lower volatility than the S&P 500, I think. And then, CMVP has a slightly, the indices that track that ETF also has a lower volatility than the TSX 60. Even with a little bit of leverage, it's still not as it's going to be, there's going to be less potential volatility because the investing dividend growers, which are quality names.
It's quality. Yeah.
Yeah. It's really driven by the quality of the companies, and because they're not necessarily high growth names. They're more like, dividend growers. And so on average, they just have, lower volatility. The lower volatility, not something that we select for, but it's something that just happens because of how we design the portfolio of dividend growing companies.
Nick, let's bring it home for advisors and investors watching or listening, thinking about portfolio construction. How do you envision something like DayMAX being used in practice? Like, what's the most natural use of this solution or this suite of solutions in the DayMAX suite as a complement to the traditional covered call strategies? Is it a dedicated higher income sleeve or something else entirely? And is there a client profile or portfolio context where this fits particularly well?
I mean, I think because there is a little bit of leverage, modest leverage in the product, maybe it's not perfect for just any client. I think any client has to be comfortable with a product that has a modest amount of leverage. But for someone who is comfortable with that, it can really, I think it fits either as a small portion of your equity exposure. Like if you have, one of the examples that we always give for advisors is, look, you have a regular 60-40 portfolio, and it yields maybe 3% or something close to that, but you need to get to 4% or 4.5%. Then you can allocate a small portion of your equity exposure. Suppose you have your long Canadian equities, you can replace some of your Canadian equities with C-Day, and then that will give you just a little bit of it, maybe even 10% will give you a big boost in the overall yield of the portfolio. If you already have covered calls, you can replace part of that covered call exposure with a little bit of the DayMAXs, knowing that you're going to get a slightly higher yield and also a slightly different payout, a slightly different risk profile, because you're monetizing daily volatility as opposed to monetizing monthly volatility. So, you're almost diversifying how you are monetizing volatility. So if you're already familiar with covered call ETFs, then this fits in nicely to get a little bit of extra income in. And also helps you diversify some of your cash flows. Again, maybe you don't want all your money at the end of the month. You want to stagger it a little bit. You want some money, halfway through the month, some money at the end of the month. And so again, the DayMAXs can help a little bit with that. So overall, I would say, we like to, we see these products as helping in a portfolio for your income needs. It's not meant to be 100% of your portfolio.
Exactly.
You get, because you are foregoing, that upside and all the things that we generally talk about with covered calls, but you don't need too much of those of that of an allocation to make a pretty sizable difference to the overall yield of your portfolio, and that frees up the rest of your portfolio to own other sectors, other assets on which you're not foregoing the upside.
Yeah, I think it's important. It's not necessarily a core holding. It's something that is a building block, though. To consider it as a tool, as a building block, as something you can use to shift your portfolio around and diversify your income sources to enhance your overall income. Where you need to. You can do that obviously very gradually. You can do that very meaningfully, as you said, and taking even the concept of capital efficiency in mind, it does give you the opportunity, because of the enhancement, to free up other parts of your portfolio for other strategies. And it's low cost. I think the other thing I want to point out is just so that there's no misconception at all about what we've talked about today, just to sort of cap off our discussion, is that this is a long only strategy. It's not about, there is obviously a great deal of risk management within the portfolio that keeps it in that medium risk range. Very interesting. Talk about the tax efficiency aspect of the DayMAX suite. What are some of the considerations there?
Yeah, so this is one of the big advantages of covered call strategies, and it also applies in the case of the DayMAX, which is those premiums are taxed as capital gains. But when we have losses on certain days versus days on other days, some of those losses can offset other gains. So at the end of the year, you're going to get your full premium, and you're going to get dividends from the underlying holdings, but you're going to get a mix of dividends, capital gains, and return on capital. And the return on capital comes from the fact that some of those capital gains losses offset some of the gains. And so from a tax perspective, for most people, it's more advantageous to get capital gains, dividends, and return on capital relative to getting regular income. Now, for a U.S. focused DayMAXs, you're going to get the foreign income from those holdings. But overall, not only are you getting a pretty nice, a bigger yield on the product, but you're also getting a fairly tax efficient yield for the end investor.
So theoretically, you could calibrate it so that it matches up with your desired after-tax income.
Correct. Yeah.
Right. Excellent. Thank you so much for coming on.
Thanks, Pierre.